Deloitte Tax. Welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues and developments. I'm Carrie Falkenhayn, your host for Tax News and Views. And today we're going to be talking about estate tax planning. It's an interesting time from a tax policy perspective as it relates to the estate tax. So joining me today from Deloitte's private wealth practice are Laura, Sam, and Aaron. Laura is the National Estate and Gift Tax Technical Leader within Deloitte's Washington National Tax Group. Sam also is part of that group within W&T, and Aaron now sits in the practice after doing a rotation as part of that same W&T technical area. So thank you all for bringing your deep experience on this important topic for our audience, especially for those who work with family businesses or other wealthy individuals. And Laura, I'll start with you. Why is now the time to be talking about estate planning?
Thanks, Carrie. Since 2017, taxpayers have benefited from a doubled lifetime basic exclusion amount, or BEA. And as of 2024, every individual can use their $13.61 million of BEA to transfer assets during life or at death, completely transfer tax-free. Now, absent any sort of legislation, that exemption amount, the BEA, is going to be effectively reduced by half on January 1st, 2026. So a failure to utilize that available exclusion before it decreases might result in more estate tax being paid and less assets being passed to the heirs. Now, I certainly think that the prospects of the increased exclusion getting extended are better now that the new administration is coming in. But my recommendation continues to be to plan with what we know. We have a generous exclusion amount that's available. And so if you're in a position where you expect to have a taxable estate, have the wherewithal and desire to make gifts, well, you should be considering doing that rather than waiting for any sort of absolute certainty. Aaron, I'm going to turn it over to you for a minute. For everybody that's listening, thinking about how to use their exemption, what's your advice on how to start thinking about that?
Yeah, of course, Laura. This is a perfect time for everyone to review their estate documents. I always like to recommend taking a closer look at what do your current documents say, see where your assets are currently slated to go, and if that's still what you actually want to happen. Another item to focus on is what would the estate tax liability be if something were to happen today, and how is that actually going to be paid? The current estate tax rate is 40%. If you're someone with a lot of liquid assets, this may not be a big concern, but what if your estate is very illiquid? For example, you have 80% of your estate is ownership in a family business that you have. Is the plan to sell the business for liquidity, get liquidity from another source, or maybe you qualify for a deferral? These are all questions to start considering sooner rather than later.
Sam, let's bring you into this conversation. Aside from this law change that may or may not happen, what are some of the other reasons that individuals should focus on estate planning now?
There are many non-estate tax-driven reasons to focus on estate planning. These factors include asset protection and income tax consideration, among other items. For ultra-high net worth individuals, where the exclusion amount that Laura discussed is not seen as a major factor driving wealth transfer, ensuring that your estate plan accomplishes your current tax and non-tax objectives should remain front of mind. Specifically, for business owners, consider whether to incorporate interest in such business in wealth transfer plans, either via outright gifts or gifts and trusts, before the business matures and the value increases. Once the asset is out of your estate, to the extent the asset appreciates, that appreciation will be outside of the transfer tax system. However, with any planning with a business asset, the focus needs to be on the business and the individual owner's cash flow needs. In addition, significant life milestones such as marriage, divorce, or the birth of a child may trigger the need for estate planning adjustments. These events and others, for example, a liquidity event, can bring about substantial changes in an individual's financial and personal circumstances, which should be reflected in their estate plans. These events are also good reminders to check that beneficiary designations for life insurance, retirement plans, and other accounts properly reflect your intentions.
So some of our audience may already think they're not going to be paying any estate tax. For example, if they've chosen to leave their entire estate to a charity, do they still need to focus on estate planning?
Oh, yes, and maybe even more so. Although charitable estates may not pay estate tax, they can be much more complicated than a taxable estate. And a lot of times it's a heavier administration burden on the executor or whoever is administering the estate. It's important to identify and plan for potential issues now that may arise. This includes an analysis of which assets may be considered for transfer to the charity. For example, a private foundation can't hold an operating business. Or what if a charity is not able to take the assets that you're intending for them to receive, or they don't want the assets? There could be income tax implications as well of a charitable bequest, and you'll want to make sure that it qualifies for the charitable deduction. You'll also want to consider the application of private foundation rules, including who will be a disqualified person when a taxpayer passes. And finally, if you're someone who has a family office, you should pay particular attention if the entire estate is left to charity. There can be immediate self-dealing rules to contend with after the death of a taxpayer. Planning in advance can mitigate challenges in the estate administration period, especially when it comes to charitable estates.
So still lots to think about, even if you're going to be giving your estate to charity. Thank you for that, Erin. Laura, I want to turn to you. We've been hearing that the IRS is increasing their audit rates on high wealth taxpayers. How does that area of activity impact the estate tax area?
So just like we're seeing an increase in audits on the individual income tax side, we're seeing an increase on the estate tax side too. So just to level set for a minute, absolutely every single estate tax return that gets filed is going to be looked at by a human individual at the IRS. And that person's going to make a determination as to whether or not it's going to be selected for examination. From what I heard from talking with the service last week, many of those people that are looking at the returns are estate tax attorneys, and all of them have law degrees. And they said that they're hiring additional experienced agents. So my expectation is that these people that are coming in are knowledgeable about the sophisticated planning that's being done, and they're going to be positioned to identify potential issues for exam. So some of the things that we're seeing come up under exam for estate tax returns is valuations of hard to value assets and art, unreported gifts, and in particular, whether expenses that are claimed on the estate tax return are reasonable in amount and necessarily incurred. Knowing that the IRS is increasing its efforts around estate tax, I think puts an emphasis on audit readiness. A lot of high net worth individuals, they think about that concept with respect to their Form 1040, but planning ahead for that eventual estate tax return makes a lot of sense too. So if you're sitting here right now, trying to project out the future implications of your estate plan can help your family office, your family enterprise, identify and quantify potential issues that might come up in an examination. And my recommendation here for estate tax audit readiness would be to start by reviewing your prior gifting transactions. Make sure that all your gifts have been properly reported, including gifts to life insurance trusts that are frequently overlooked. And then gather all the documents that are going to be used to assist with the preparation of the estate tax return, including all of those prior gift tax return filings and copies of trust agreements. And then maybe consider doing a dry run of the preparation of the estate tax return. And that'll help identify potential exposure areas. If you're able to identify those early on, like right now, it may help you clean them up and mitigate exposure down the road.
Terrific. Sam, to close us out, maybe take us through how planning now can really position a family or their business for the eventual administration of the estate.
Thanks, Carrie. Yes, the process of settling an estate can be quite extensive. That process begins with gathering and determining the value of assets and the eventual distribution of those assets. For very high net worth individuals, this process can range from 4 up to 10 years or possibly even more. Oftentimes, the family business or family office ends up responsible for driving this process. It's important to note that many tax and non-tax tasks need to be completed in the short term after an individual's passing. By identifying these tasks, the family office, family advisors, and the family itself can be better equipped to manage the impact of a loved one's passing. I recommend the development of a checklist detailing specific tax and non-tax related actions to follow and the party responsible for them. Such a checklist can include work streams around securing access to records and assets, preparing an estate asset inventory, listing key tax filing deadlines, estimating cash flow needs, identifying appraisers for any necessary valuations, and more. Having such a plan in place prior to death can ease some of the emotional and mental burden for those responsible for administering the estate.
Thank you, Sam, Erin, and Laura. And I know we work with our clients in those areas that you just described. If our audience would like more information, you can, of course, reach out to any of our speakers via LinkedIn. But I'd also encourage you to go to Deloitte.com. There's a great article there. Just search on Assessing Your Wealth Transfer Legacy in 2024. Lots more information there. And of course, we'll stay close if we see future policy changes as part of the new administration's tax agenda. As always, I'd like to thank our audience for joining us. Everyone, continue to be well.